Hello and welcome to the Genuine Learning blog. My name is Melisa Galasso, and I'm actually really excited to be here to talk about FinREC's recent proposal for programmatic investments. This is a project near and dear to my heart. If you've been in any of our nonprofit classes over the last couple of years, this is something I have been very vocal about and very excited to be included in this update. And so FinREC has put this out for comment. And so if you have any thoughts, I would love for you to share them. Sam Cox is one of my favorite humans at the AICPA, and she would be a great person to reach out to with that information. But this is a working draft. So the not-for-profit guide comes out once a year, and they are looking to make some significant changes to particularly the chapter on programmatic loans and programmatic investments. So these are certain paragraphs within Chapter 8 of programmatic investments for the nonprofit guide. And it's focused on a new accounting standard that came out, ASU 2025-07, which made a change to the scope of derivatives. And before this guidance came out, in previous versions of the guide, there was some pretty controversial requirements set foot because when we think about programmatic investments, these are investments that are made by nonprofits predominantly to achieve its mission, right? They're mission oriented. So maybe my mission is to help underprivileged kids go to college. So I might give them a below interest rate loan, or I might give them a forgivable loan. And if they graduate and they do some community service, I'm going to forgive that loan. And because the intent is not to generate income or interest, but really to meet my mission, we call these programmatic investments. And these programmatic investments have specialty accounting under 958. However, a lot of times, if you were to look at particularly the conditional requirements related to programmatic loans, you often find that they theoretically meet the definition of a derivative because we have conditional or uncertain cash flows. And so that triggers topic 815. And so a few years ago, when they were looking at the programmatic investment chapter, FinREC said, you know what, there is sort of an issue here because 815 does not scope out programmatic investments or nonprofit organizations. So technically, both standards apply. 958 specific to these types of organizations and nonprofits, but also 815 for derivative accounting. So last time they updated the chapter heavily, they basically said, look, you can make an accounting policy election to apply 958 and skip the 815, but you would have to document that was your policy. Now, most people don't think of that as a policy because they think of it as the guidance in 958 for nonprofits. But because of this sort of issue with 815, we were looking forward to the issuance of ASU 2025-07. And ASU 2025-07 updates the definition of a derivative to exclude from the definition when the underlying is tied to the activities or the business operations of a particular entity. And when you think about this, these are how programmatic investments are written. So here's a copy. I know it's heinous looking. I apologize. But it is a red line and it's a working draft. So they not only have the highlights versus the strikeouts, but they also have the draft across it. So it makes it unfun to provide to you. But when we're looking at a contractual feature, such as a conditional forgiveness clause, previously you'll notice everything at the bottom was talking about sort of the guidelines around bifurcation of a derivative. We're going to go on to say that you should evaluate it for bifurcation of a derivative unless a scope exception applies. And so for these programmatic loans, we should determine if the conditional promise to give contains an underlying an occurrence of some event that triggers the forgiveness that is based on the operations or activities specific to one of the parties, which is the scope exception in ASU 2025-07. And so as a result, we're going to have this now opportunity to say if the contractual feature in the programmatic loan with the conditional promise meets the scope exception, then we don't have to worry about this, right? We just go back to straight up nonprofit accounting, and that feature would not be subject to 815 and would be required to be accounted for under 958-605 and ASC 72025. And so these would be conditional promises. They have barriers that have to be overcome. So we would recognize the loan. And then when the barriers are met or substantially met, we would be able to recognize that forgiveness. So I love that they have this included now, that they strike all of that bifurcated derivative and they apply the new ASU as it was intended to help with these types of situations. They also go on to provide an example of a specific loan and how that loan treatment would be incurred. And so you can kind of see what we had recommended previously. Now, I do serve on FinREC. I am a proud member of the Financial Reporting Executive Committee of the AICPA, and I'm excited that we're addressing this chapter and updating it for this new ASU. So I hope you will consider giving some feedback to Samantha Cox. Her email is samantha.cox@aicpa.com. Comments are due by July 3rd of 2026. So if you work in the nonprofit arena and this is something that you're passionate about, I would encourage you to reach out to her and to give her your feedback. But with that, I want to thank you for joining me on this week's blog, and I look forward to seeing you on a future blog. Have a great day, guys. Bye-bye.